Good morning, David. How are you?
Morning, Alexandra. I'm good. How are you doing?
Doing great. You're being busy.
Yes. Sorry about that.
Hey, you're good. You're good. We were just talking about the market being super low on inventory and the fact that I personally wrote 4 offers last week, and 3 out of which ended up in the multiple offer situation. So
Mm.
that tells you that, like on one side we have the news that are saying, oh, the market is crashing, like everything is so bad, nobody's buying anything, and then like 75% of my offers were in the multiple offer situations, and we had to, like, one was over the list price. So we're not talking about the favorable terms for the buyers anymore. We're already talking about, like, we're switching to the point where we need to get a house. Like, we need to get a house, and like just getting the house is already a great thing. So guys, this spring is going to be very active. It's going to be like very tight on inventory.
And this is when the Fed is still increasing interest rates.
Exactly. Exactly. And this is one of the things, like I've had so many conversations about this, the interest rates and how to, how to strategize with the interest rates increasing and, like the mortgage rates floating, like you never know when to catch it. And because you're a strategy guy and your whole team is all about strategy, I wanted to break it down with you for everybody who's going to listen to us either now or later on. So, David, what is the best strategy? Like, I have a lot of buyers who are like, oh, the interest rates are so high, I don't even want to spend time to get the documents together to get pre-approved.
Yes.
And then we have other people who are actually proactive, and they're like, I want to get pre-approved now. I'm going to sit on this pre-approval, and the moment this rate drops for a couple of days, I'm going to just scoop it and grab it. So tell me, what is the best strategy? What do we do? Like, how do we take advantage of this situation? There's always something that you can do for us.
Uh, well, this is my personal opinion. I think interest rates should have little to do with one's decision to buy a home. If anything, if 2020 and 21 taught us anything, is I have to repeat myself. This really is no rocket science. When money is cheap, prices are high. When money is high, prices are cheap. Money is high now. So the Federal Reserve is still continuing to increase interest rates. That would be Jerome Powell and Neil Kashkari. So we are still on an interest rate increase, which means you're going to get as good a prices on homes as possible. You do not, when you buy a home, you don't buy a payment. You buy a home. You buy a home at a good rate, and while yes, I agree with you that the inventory is low, but there's still inventory. And you refinance when money is cheap. You don't buy when money is cheap. That's my opinion.
Absolutely. And I 100% agree with you. And I always tell my customers that it's a big difference, because when the money is cheap and you already own the house, you do not compete with other people. You refinance
Absolutely.
on your own timeline.
Absolutely.
You don't need to be in a multiple offer situation. You don't need to pay over the list price. The house is already yours, and you already know what the current mortgage balance is.
Absolutely.
Correct. And you refinance on your own terms. Like, you don't need to rush. You don't need to be under the pressure. When the mortgage rates are low and you're trying to buy something, this is a reason number one why we saw the drastic decrease in FHA loans and VA loans and the low down payment loans during the pandemic years, because these people could just not afford to pay over the appraised value to cover the, to cover 25, 35, $45,000 difference between the list, like between the appraised value and the purchase price. These are the people that, like that they wanted the cheap money and they had the pre-approvals, but they had no ability to buy the property because they were pushed out of the market. And that's why right now we have a lot of these buyers are coming back, and they are actually feeling stronger, and they actually feel like they can finally afford something and not, like not to be in the situation of 20 offers. However, like I said, during last week, I had multiple offer situations. It was like 2 and 3 offers, but there were still multiple offer situations because the properties were worth it. And like we submitted $15,000 over the list price.
So that's alarming, right? That's alarming.
It is
of what's coming, because this in February we've had a 40% uptick in leads in purchase pipeline, and I know you and I are working on many clients together. So when we were working on as many clients, say 2 or 3 months ago. So and that's the case with all my relationships, realtor relationships, and leads are up. And what I'm also seeing is seller concessions are going away slowly, which means there's more buyers out there and sellers are more confident. They're demanding a higher value, just to solidify what you're saying, and they're not really paying someone to buy a house anymore.
absolutely. And but I wanted you to break down the logic behind like why our buyers are getting pre-approved right now, even though like you and I, we have some buyers who's been pre-approved like since October, and they keep on renewing their documents. They're keeping up with their application, but we haven't purchased anything yet. Can you please tell what is the advantage of it, like from the mortgage standpoint, and I will say what is the advantage of it from the, from the buyer standpoint?
I honestly don't know what the advantage is. You tell me. I think that people should buy now, and I meet with 2 or 3 new clients every day. Most of them are first-time home buyers at our conference room, and a lot of them seem to think the prices are going to crash. So you can't help them. I mean, I could tell them what I think, but I also have to be careful because no one really knows. I don't even think Jerome Powell knows what's going to happen. Even the Fed, the most powerful person in the financial world, he still measures the result of his rate increases, and then he doesn't know what's going to happen. So I'm deeply convinced no one knows what's going to happen. I have my opinion. I share it with clients, and I do stress that it's my own opinion. People seem to think that homes are going to crash. Fannie Mae just came out with their February release of their rate forecast for 2024 and 25, and rates, the 23, 24, and 25. I'll send that to you if you want to. And basically, so the highest rate on that forecast was January of this year. It was at 6.7%. And according to Fannie Mae, what their economists think, obviously they have an army of economists, they're thinking that rates are going to slowly go down. Not as quickly as I want it to, but their forecast is rates are going to slowly decline all the way to in 2025. 2025 rates being in the 5s.
And I would like to come back to it, like talking about the advantages. The reason why I have my, I have my clients getting pre-approvals is exactly what happens pretty much every Saturday when I call you up and I say, we need an updated approval because, finally the house came on the market, and you don't need to ask my buyers for more documents because you already have everything in pipeline. And with the inventory the way it is right now, like some of my clients, we see like one house in 2 or 3 weeks that we might like, and the moment we see it, we want to be ready, we want to be on the go. And another thing is that obviously we're all watching the rates, and the moment the rates go down, all of my clients are like, okay, let's go, and we even had a couple of, we have a client who is waiting on a new home build, and the moment the rates went down, she's like, okay, now I'm ready to pull the trigger. So, and like her trigger was the interest down. So these are the things that people this is the things that I see as an advantage of being pre-approved, and it doesn't cost you any money to get pre-approval. It doesn't cost you any money to get your credit ready and to understand what you can afford, correct?
So, yes, of course. So that our message, we could probably summarize all of these videos that you and I have done into certain bullet points. And one of the messages has been, see a loan officer as soon as you can. Even if it's up to you when you want to buy a house, in the summer, in the fall, next year, but see a loan officer. I wish I could charge you. I'm not allowed to. It's illegal. We're not allowed to charge you for consultation. Come waste my time if you think it's a waste. A lot of people are, David, I don't want to waste your time. Come talk to me. Let's do a soft credit pull, see what you need to work on. You'll be surprised how many times people discover a collection on their credit report. Now we have things we have to work on. We got to pay down cards to get a better interest rate, FICO score than an interest rate. We have to deposit money and season money in our bank account. There's so many things. Most people walk out with a list of things to do in mind. So get ready. So you don't want the rates, whatever you think is the time that you're going to want to pull the trigger, whether it's dropping rates or dropping prices, you want to be ready for that time. So get ready instead of waiting and calling us when you think it's ready. Like, David, it's happened before. People are called, David, send me a pre-approval. You're not ready. You still have another 2-3 months of work to do. So get the work done. And if I tell you you're perfect, your situation's perfect, here's a pre-approval letter, well, all the power to you. Go chill, wait, and whenever you feel you're ready to make an offer, you can.
Absolutely, and I would add to it, the right time to get pre-approved is before you see the house of your dream, the house that you want to submit an offer on. By the time you see that house on the market or coming soon to the market, guys, it's like you should have your letter. Yeah. You should have your letter ready. And this spring is not going to be, it's not going to be an easy on the buyers because of the low inventory. You have to be ready to go. You have to be very certain. Most of the time you will not have a night or two to sleep on it. This is not going to be our spring market where you sleep on your decision whether you submit an offer or not. Like, we're working from the reverse strategy. We submit an offer and then we think, like, if you want to, you can actually cancel or withdraw your offer. But first thing you do, you submit an offer on the property you like if that attracted your attention. But I want to go back to the interest rates and to, to what is Fannie Mae posting. So there is a very interesting thing that, and I know you have this conversation with the clients all the time, like they see these low interest rates online. And they're like, but I saw it on the internet, like, why am I not getting this rate? And I keep referring them to the same thing that Fannie Mae published not that long ago, that the rates that Fannie Mae publishes, they're actually published with 1 point buy down.
That I'm not aware of. Send that to me. I'm not aware of that.
This is something that that came up to my attention, and I checked on this information. So Fannie Mae publishes the rates with the 1 point buy down. That's why every time when you see like those government rates, you'll see the rate with the 1 point buy down.
Interesting.
But also because this year Fannie Mae changed the rules and they no longer disclose what kind of fees or points they're publishing. So guys, you will always see the lower interest rates when it comes to Fannie Mae. That's why, you look at Fannie Mae and they're like, oh, 6.5. You come to the mortgage lender and they're like, how come it's 7? Like, how come it's 7.25? This is how come. Because if it doesn't cost you, like, you can have 6.5, but it's going to cost you a buy down.
So one thing I do, I don't even know if I'm supposed to do this, but when clients come into our office, what I do is I usually open Quicken Loans, their website, and compare the rate we're quoting to them, and then we're like by thousands of dollars cheaper. I don't even know if it's legal, but I do it because it's a name. It's the biggest lender in the country, and that's the benefits of working with a broker when we have the ability to shop. I'm plugging myself here, but it really is a benefit when we're shopping many banks versus one bank. When you go to your Wells Fargo, Bank of America, or whoever, you really have one product. They only have one product, and that's what we do. We shop around to different banks. We're brokers. We get the decision to where to send it to, and once I have determined who the cheaper bank is for that particular client, we open at the conference room on the big screen, open Quicken's rates right there, and every time I'm like, all right, I wonder what's going to happen. Is Quicken's going to be cheaper than me? And we've been cheaper every time. So yeah. So I don't know the Freddie Macs and Fannie Mae's, what rates they publish. I have no clue, but I'm actually real world competition of mine. We're way cheaper.
Absolutely. And David, can you please break down the difference between the mortgage brokers and like between using the mortgage broker and going to the bank?
So
From the lender's standpoint.
when you go to a bank, the bank is taking your application, underwriting, and funding your loan. They only have one product, one 30-year fixed, one whatever FHA. That's it. Now, David, a broker. Sorry, the broker has. We don't have underwriting in here. We don't underwrite loans. We do pull your credit. We do income calculation. We do the file build out, and we basically issue the pre-approval based on our opinion how solid you are. And at that moment, once you're ready, we're going to get the electronic underwriting approval. Once we have that solid confidence, you're good. We're going to start shopping, and we work with like 23 different banks. We're going to, we have a special tool. We plug in information, and we basically see who the
I think David went on you froze for a second.
I apologize.
Probably you had the call coming.
Block my calls this morning. I apologize.
No.
So yes, we do shop. We do have a tool that, once we plug in the information, the down payment, the credit score, the loan type, all these things, the county, there's a bunch of factors that go into determining the rate. It does spit out a list of lenders, and then we could compare them side by side and see which one the cheapest one is. We don't care. We get paid the same. We have no control over interest rate, or we're not incentivized by using one bank versus another. Whoever the cheapest one is makes me look good in front of the client. That's who we choose. That's how brokers are way more beneficial, and quite often our rates are way lower than that of a bank or a direct lender.
Also, the brokers work with so many different programs, and if these are non-QM and mortgages, so can you tell us what are the non-QM mortgages and what is the difference? Like if you are not a straightforward, like fitted into the box buyer, like if I have a particular situation that is not very, like I have not been a W-2 employee for a very long time. So how is using a mortgage broker more beneficial for me than going to the bank?
Mm-hmm. So back in 2011, I think, once the Dodd-Frank the overhaul came out, they came up with this understanding of qualified mortgage. Qualified mortgage would be your conforming loan through Fannie Mae or Freddie Mac, the owner-occupied, full doc, whatnot. Once you step outside of the qualified mortgage parameters, you will find yourself in a whole different industry, which is called non-QM, non-qualified mortgages. And these are smaller lenders. They don't have government backing. These could be your Morgan Stanleys of this world. Insurance companies love investing in these sorts of products. Now, they have different guidelines, and there's so many different products for different people. Whether you're self-employed and you don't want to show your taxes, let's say you're an Uber driver, you're a hairdresser, and we can show your bank statements. You're buying an investment property, we can show the future cash flow of this property, so we don't have to show your taxes. So qualified non-QM is basically the alternative loan, alternative paper. It doesn't mean it's subprime, but sometimes people misconstrue this. Go back to 2006. It's not. It's subprime in a sense. It's not government backed, but the down payment requirements, the stringent underwriting requirements. It's not easier to get a non-QM loan. It's just possible for some folks. We spend more effort getting non-QM loans. It's not our favorite, but if we're gonna, once you come in, once you fill out an application, we're gonna see if you fit in that box of conventional FHA, VA, whatever, full documentation loans. And if you don't, we're gonna explore the non-QM just so we don't have to decline you.
And David, did I hear you correctly? One of the reasons that you don't think that we will have 2008 repeating is the loan underwriting and the guidelines for the loans, even though we have a good amount of non-QM loans, but it's still our guidelines and requirements for the current loans, whether they're QM or non-QM, they're way stricter.
Absolutely.
And they have higher requirements than ever before. And every year you see those requirements are getting more and more strict.
To spare you the history sort of trip back to 2005 and 6 when I had started doing loans in 2005, very quickly, back then we had the Ninas, the Ninja loans, no income, no asset, the all those no doc loans, stated income loans, all those are gone now. So yes, non-QM is still being underwritten. There's still some sort of a verification of your ability to repay. The number one factor that the bank is looking for is your ability to repay that monthly payment. And non-QM loans, what they are, they're simply looking at different places instead of your taxes for your ability to repay. If they determine that your ability to repay doesn't exist, you cannot repay for this, you're not getting that mortgage.
So let's talk about the ability to repay. Like I remember when I just got my license in 2011, I still had people who would call me and they would be like, I want to buy a house, but I don't have a job. And I was like, are you joking? I was like, is that a joke? But these are the people who remembered, who remembered and they were on the market, let's say,
right,
on the purchase market before 2008. And to me, it sounded bizarre. Like, how are you going to buy a house if you don't have a job, if you don't have a steady income coming in? Like, not to say that you have to have a job, but you have to have an income coming in. It can be passive income, that's absolutely fine, but you have to have income coming in. So let's talk about the ability to repay. So what goes into the ability to repay and how, what is the ability to repay? Is it is it income? How is it calculated? And how can we increase, what factors increase or decrease the ability of a certain person to repay
So
their
it depends
mortgage?
on the loan program. If you're self-employed, for example, and your gross money, whether that's you're doing Airbnb, you're selling something on Amazon, or you're an Uber driver, you're a 1099 non-employee contractor, your money is deposited into your bank account, and most people file their taxes on Schedule C, and I think it's worthy of repeating that Schedule C is a very expensive way to pay taxes, so people tend to kill their income. That's just the truth. Okay, we're not going to run away from the truth. That's what happens in front of every tax person when most non-employee contractors end up seeing how much they need to pay. So depending on the loan program, if you're self-employed, number one, and if you want to buy an owner-occupied home, we could look at your 12 months bank statements, 12 months deposits, and you get 50% of your deposits as income. So I really don't want to bore your audience, but 50% of your income deposited it for the last 12 months, accumulated, divided by half, that would be the monthly payment you can qualify for. We don't go through this. We get the 12 months bank statement, send it to the bank, let them calculate. It's their responsibility to underwrite the loan, so they may as well do that work for me and tell me what the monthly payment is. once we have the monthly income for that particular loan program, that's when we start, issue the pre-approval letter based on that income. So monthly income is ultimately what's going to matter, and minus your other expenses. There, different loans have different what's called DTI, debt to income ratio. How much is your debt? Now, we do look at your proposed loan, this new loan that you want to get. We do look at that. Plus, do you have student loans? Do you have credit cards? Do you have car payments? All these monthly minimum payments get added to your monthly, your mortgage payment. Generally, it needs to be less than 50% of your monthly income. In my experience, most people that try to get their DTI are wrong because there's multiple factors to go into this. Let us do the work for you.
This is exactly what I wanted to talk to you about. So I get, I get people tell me, oh, I went online, I put in the information myself, and the online, online websites spit out the pre-approval letter for me, and now none of the sellers want to accept my offer because they all look at this pre-approval letter and they're like, oh, no, not good enough, and they're like, why is this not good enough? And I keep explaining that there are a lot of factors that go into that DTI, and that when you guys calculate the income and you look at the debt, there are things that are actually go against your income, and there's things that are not calculated towards your income. For example, David, do medical bills, like medical debts, calculate against your income?
If you have a monthly payment reporting, yes. If that's a collection, then no. Again, depends on the loan program that we're using. So there's no blanket answer for any loan program.
So there are thousands of different factors that go in, and there is no such a thing as one answer fit it all, correct? One size fit it all, because every situation is different. And also, guys, sometimes when you put your information in and the the website tells you, oh no, you don't qualify, the things that you might be missing out is that you might not be calculating your spouse's income. You might have something, on your credit, that you're, let's say you might have a car on your credit that in reality, this car payment is made by your company, not by you personally. And that is not being calculated towards your debt. Am I correct?
That's correct. It's called contingent liability. And I do talk about this, and I do when we do consult our clients, it's not just for this loan, it's for long term. So I tell them, listen, pay your car out of your business account. And once you have 12 payments, once it's properly been accounted for in your business taxes, so the underwriter's going to look at two things: 12 payments from your business account, not your personal account, and this deduction, the principal payment, which gets amortized and depreciated, and also the interest deduction, both are properly deducted from your taxes. Even though that liability shows on your personal credit history, we get to ignore it because it's technically not your liability. It's the business's liability, and the business has been paying for it.
Excellent. And this is something that the online resource will never propose to you, will never show you, but that one payment could make or break a deal for you. It could it could make you think that you don't qualify, or that you qualify for less amount of a mortgage. So another thing, can you tell me who are the co-signers? And why would we use the co-signers? Would we use them for credit? Would we use them for income? And is there any age
Great question.
restriction? That is another thing, yes, that people are asking, age restrictions. So talk to me about that. Co-signers and age restrictions.
Age restriction is illegal, so there's no age restriction. You could be 120 years old. You can still co-sign for your granddaughter. But co-signers, we only bring in co-signers to contribute with income. If our borrower's income is not enough, then we ask her, hey, who could co-sign for you? Do you have a brother, sister, mom, dad, whoever, who can co-sign for you? As far as credit, it does not contribute. by any means. Most people, for some reason, tend to think that if they bring in a higher credit score, somehow it's going to increase the median credit score, whatever that average. We don't average. We're still going to use the lowest one. So unless you contribute with your income, there's no reason for you to be on the application.
Okay, so co-signers, we only need the co-signers if we need additional income. And
Income
co-signer
only.
can be any person, correct? Does it have to be a relative, or can it be a friend?
It depends whether you're doing conventional or FHA loans, but it could be a cousin or fiance in case of conventional loans. So it really depends on case-by-case basis.
Okay, but it is different with the VA loans,
It
correct? We cannot have anybody on the VA loan except for the spouses or VA eligible
VA
people, correct?
government loans, FHAs and VAs are more restrictive when it comes to that. Yes.
Absolutely. So, guys, there's a lot of ins and outs that the mortgage team needs to know. Now, I want to go back to the age restriction. So, how old should I be to get, should I be to be eligible for my first mortgage? What is
Well,
the?
mortgage
Mhm.
requires credit score, and I believe credit score is established at 18 years old. So 18 would be when you have your first FICO score if you're doing things right. And also mortgage requires, there's no minimum age to get a mortgage, but you need a credit score and you need 2 years of employment. Hence, well, 18, I would say, in case of FHA, does allow high school diploma to be used as employment history. So yeah, you could be
Once again, so you can use your
in
school.
lieu of employment history for FHA loans. Yes, so you could graduate high school, find a job, apply for a mortgage as long as you have decent credit.
High school, college, correct? High
Co-
school, college, that all could be used for the FHA loans as the part of your
as well,
job history.
college would work for conventional as well. College is a bit tricky because now we're going to have to verify your transcripts for the last 2 years, all your semesters, and you better be working in the same line of work that you graduated from. So we're going to need the diploma, the transcripts, and you cannot be a baker or a shoemaker if you graduated from I don't know, a CPA or a law firm, whatever. So
But you can if you graduated from the business school, correct? I'm kidding. I'm kidding.
yeah,
David, I'm kidding.
business school, yeah. It's the stigma they get because it really doesn't. It's so broad, right?
Correct.
Um, yeah, I haven't had that happen yet. I guess I could make the argument in front of an underwriter.
Well, you work
It
with a lot of
pertains to every
realtors who
business.
graduated from the business school.
Okay. Okay.
You
It
do.
hasn't happened yet.
You do.
I guess they all worked throughout college, so that hasn't been an issue yet. But we're learning.
Absolutely. Now, if we're on the topic of college, so college debt, like student debt and mortgage, pros and cons, what to be aware of, what not to do if you are trying to get, like if you're trying to get a mortgage application and thinking of getting into the college or getting
That's a good question. Wonderful question. So after COVID, the federal government that issues these student loans, Sallie Mae, whatnot, they automatically placed everyone on a COVID payment, which I would say all credit reports that I pull right now that have a credit, that have a student loan are showing zero payment. Zero payment is not acceptable for Fannie Mae, for Freddie Mac, or any of them, VA, FHA, whatnot. So if you have a zero payment reporting on your credit report, the following is going to happen. If it's an FHA, I have to hit you with 0.5% monthly payment of your balance. So I multiply your balance of all your total loans that you have outstanding, and by 0.5 point, not we add that to your debt to income ratio. We consider that as monthly payment. For conventional loans, Fannie Mae requires 1%, Freddie Mac requires 0.5%, VA, FHA require 0.5%. So if we're doing conventional, I would probably send that loan to Freddie Mac instead of Fannie Mae. But that's the law, what we have to do according to the guidelines if you have zero. And what happens a lot of times, Alexandra, is that 0.5 point is way higher than if you were to call and get on a payment plan. So a lot of times people could call and get on a payment plan, which that payment plan ends up being lower. So their monthly payment, the qualification goes high because I have to hit them with less debt, so to speak. Now, what you can do, and this is not the case for everyone, but definitely for some folks, if you have what's called IBR, income-based repayment, if your monthly payment is based on your income, and it's still showing zero, what I'm going to need you to do is call your Sally, whatever, the federal, whoever's servicing your student loan, and get a letter from them that says that so-and-so does not have to pay, is on an income-based repayment plan, and his or her payment is zero all the way till December 31, 2023, 24, or whatnot, at least 6 months. Give me 6 months. Once you give me that letter, then we can completely ignore your student loans. We don't have to add another liability. We don't have to hit you with a percentage of your liability.
So if I heard you correctly, that if anybody who is listening to us right now or will be listening later on had a problem getting their mortgage application completed or getting their mortgage because of the student loan, they really, really need to dig deeper and see all the different options that they have for themselves in order to see if something was not done correctly and if there are ways how they could actually overcome this obstacle with the student payment. Correct, with the student
That's
payment,
correct.
if that is something that prevented them from getting a mortgage.
That's correct. Our team is highly trained, and that's one of the steps they have to go through before they issue a pre-approval.
And this is the reason why we like working with you and your team, because you guys are a wealth of knowledge on all those different topics, and you can pick and you can pick apart everything that is going on with our clients' credits, with our clients' payments, and there's so many moving parts. It's just an incredible amount, and it is impossible. I'm surprised how you guys do that. I understand it is years of experience and a tremendous amount of knowledge, but I just want people to know that it is impossible to input your information into a simple mortgage application form with 5 lines in it and have it spit out the letter, and then don't be surprised if your letter is not getting accepted or if the seller or listing agents are not taking you seriously.
Can I speak to that?
Yes.
I want to speak to that because what happens is a lot of times I have noticed, and over the years I've spoken with many listing agents that are selling a home, and they're very, very comfortable. They really want, the tendency seems to be, they want to work with someone that's local. For some reason they feel comfortable when the pre-approval is issued by someone that's actually in this city, and they can call. And they can come see me. That's never happened. No listing agents or seller has ever come see me, but they want to feel someone's here and they understand the market. Now, you and I have worked together. I have worked with many agents before, and one thing I tell my partners is I will, once I issue a pre-approval letter, if the listing agent, I love this mechanism, this works in Las Vegas, the listing agent calls me and they ask me if they have done my due diligence, what I've done to pre-approve this client. And this is such an important make or break. A lot of times that conversation is what determines if they accept your offer. And I tell my partners, I will not lie ever, because our reputation's on the line and we cherish our reputation. So on our pre-approval letter, we have in red that says we have verified assets, we have an electronic underwriting approval, we have verified income. That is something that we do stress in our pre-approval letter. We want the listing agent and the seller to see this. So the due diligence of everything we could do has been done, and I wouldn't lie for anyone. So when the listing agent calls me, it is the conversation that we tell them, listen, we have verified income, we have verified assets, we have an electronic underwriting system, we have worked with their CPA to file proper taxes. Everything is done as much as possible. All I need is a contract. I have done as much as I could. I'm done. I'm tapped out. I just need a contract to file to fund this loan. Guess what? 99% of the time, I got a contract in the morning. That conversation with me and the listing agent ends up them choosing us over others. I'm spilling secrets here. But for that reason, we do have to go through the full qualification. We have to do the work so I can convey that confidence to the listing agent.
And that circles back to be ready before you submit your offer.
Yes.
Because you would not be able to communicate to the listing agent when the listing agent has 2 or 3 offers on the table, and if you're still in the process of collecting the paperwork, this is not the conversation. This is not a reassuring conversation that you can have with the listing agent to say, hey, we got the person fully pre-approved. And from the standpoint of a listing agent, I can say that there are a lot of factors that go into the play. And for those who have not done a transaction in a while, or who has not aware what is going on behind the scenes of your transaction, like on average, any transaction that involves mortgage would include around 72 to 80 different people working on this transaction at any point of time. And we're talking about, we're not only talking about buyer, seller, listing agent, and buyer's agent. We have escrow people, we have mortgage people, we have inspectors, we have appraisers, you name it. There's so many people working on this transaction at one point of time that it is for those who have no experience with it, it seems like it's hard to manage, but that's what you hire us for. But in the at the end of the day, what is going to happen is that as a listing agent, when I work with the, buyers, lenders, and we work together. There is no such a thing as we're against each other. We work together as a team. So I need to make sure that when the questions arise, and they're usually going to arise, I want the buyer's lender to be in the same time zone with me. I do.
No kidding.
Because if I have a question at 4 p.m. Pacific Standard Time, guess what? If my buyer's lender is on the East Coast, they're already sleeping. They're not going to pick up the call, and God forbid it is Friday, I'm not getting my answer. I'm losing 3 days of my seller's time, and this is unacceptable. By my standard, this is unacceptable. Another thing, I don't want to see a 1-800 number on that pre-approval letter. 1-800 number with no extension, and I don't want to call with my question if something, if I have a little question, or if Asker has a little question. I don't want to call a 1-800 number and get a different person every single time I call, and have a hodgepodge of people not knowing what's going on in transaction.
They were not the ones that approved.
Exactly. I want to have a point of contact. And guess what? I want to have a point of contact who's, if it is a 1-800 number, it is connected through their cell phone. David knows, sometimes, I always apologize on Saturdays and Sundays, but I still call. I start my conversation with the apology, but I still call, and that is because this is important. This is how we service our clients. And so it is important for the listing agent to, to have this ability. If it is a President's Day, we're still going to call, and we're still going to, we're still going to solve the issues.
I'm
So when
taking
you
my
guys,
laptop with me when I drive out of city. When I'm going to say I'm in a park with my daughter or in Los Angeles, I still have my laptop. I know you're going to call. You're going to ask for a pre-approval letter, and we need to be ready. And above all, listing agents call. Listing agents call on weekends mostly. Shopping is done on weekends. People are home on weekends. So a 1-800
people
numbers
are
of
off on weekends. Like
people are
most
off.
people are off on weekends. This
Yeah.
is the only time when we can go and shop around because
Yes.
Monday through Friday, people work and then 5 o'clock they come home.
Yeah.
It's already dark
Yeah.
outside. We can't go shopping. We can't see anything. So
Yeah.
of course I'm going to call you on Saturday and Sunday.
So Monday morning is when contracts come in, and if you're getting a contract getting approved by a 1-800 lender that is closed or unavailable on weekends, your offer is not getting accepted. Mine is, basically. That's the truth.
Absolutely, and that's the truth. And like for those who are, like for the sellers, they also know if they work with experienced agents, like you're not getting an offer like presented to you if your listing agent has not called the lenders,
Mm-hmm.
like has not talked to the lenders, has not connected to the lender. Like it would be, like in my opinion, it would be unprofessional to present an offer to the seller if you as a listing agent did not have a conversation with the lender and did not get a feel and like didn't talk about like what is going on. Obviously, guys, don't get us wrong. It's not like we're calling the lenders and snooping around. There's only limited information that David can give me. David would never disclose like the buyer's credit score or anything like that. There is a certain information, there's a certain set of questions that we're asking, but we don't need to dig into a private information in order to understand whether the lender done improper work qualifying the buyer or not. And that is a big deal. Like that makes a huge difference, whether you're a buyer or it's seller. So if you're a seller, look at those letters. If for some reason your listing agent did not explain to you that this 1-800 number from, I don't know, mortgage.com or loan.com website, like that is not like on the scale of things, like that pre-approval is not even close to being as strong as the local lender's approval.
I agree.
And I've been to situations, like obviously when we were closing with the East Coast lenders and, like they were demanding the things that were common for their state, and that were non-existent in, like not the non-existent, but they were not common in Nevada because like we had a conventional loan where we had to complete the mold inspection, which was an additional cost on my buyer, and we had to do the termite inspection, which also my buyer had to pay for because it was a conventional loan and it is not like were they to close with the local lender, it would never be required, but we had to pay for that. And then we had to fight for the flood certification because it was required, but David would tell you not every area of Las Vegas or Henderson or North Las Vegas is subject to the flood zone. So if local lender can solve this question of the flood certification within a minute without even giving any headache or spending any of the buyers or a buyer's agent time, like David, how do you figure out the flood zoning for, like, how do you deal with the flood zone?
A flood certificate is pulled, and the flood. I believe our processor does that, and it does indicate whether that address is in a federally designated flood zone. And I could tell you that most of Las Vegas is not. Some parts of Pahrump are, and some parts of East Las Vegas are because it's just lower on elevation. But it's rare.
But it's pretty much, it takes you like a minute.
Yeah, but if you're working with an East Coast lender where first of all they don't have escrow, it's an attorney state, it's really damp and cold and wet, and so they do have termite, and in 17, 18 years in mortgages, I've only seen one termite case in Las Vegas, and that was a mobile home brought from a different state, and so that's not those are not things that we need to pay for. We need to sort of protect our clients from those extra fees that yeah, I'm
An
with you.
extra headache
Yes,
that doesn't need to be, like that doesn't need to be because like those, like, and those are not big charges, guys, and like nobody, like obviously nobody went broke, but you have enough stress. Like
yes.
going through the transaction, like moving is already enough stress, and you don't need anything extra. You don't need anything additional put on you. And our goal is to protect you and to make this as easy as possible, as quick as possible, and as painless as possible. If we can, if we can accommodate that, that would be our goal every day of the week, correct?
Would be mine for sure.
David, I need to tell you something. I really envy you today. I envy your haircut today because of what is going on outside. You didn't have to deal with the wind
Trust
today.
me. No, it got dusty though, so yeah, it was cold, so it's not pleasant.
Absolutely, but we're still there. So, guys, if you don't want to come and see David, you can always FaceTime him. You can always do a Zoom consultation with David. Like if you
That's right.
don't like the weather outside, you can do the Zoom consultations. We can do the virtual showings, but we're here for you 7 days a week. And thank you so much, David.
Thank
Did
you.
you want to tell us about the new tool that you were putting on the market, or we're going to keep it till next week?
Oh, up to you. Up to you. I am
No, that's
talking
your
about
tool. I
this.
can't I
So
can't be I can't be revealing your secrets.
so basically what I did, and if you want, we could dedicate that, or at least talk about this next week. But for years on, I looked for a tool that would help me explain certain benefits of home ownership, and there's nothing on the market that does that. There's nothing on the market that talks about, in my opinion, there are five, at least that I know of, benefits of home ownership, and there's not a tool that demonstrates that, and these are very abstract values, so to speak. So we built a tool, and I use this at our conference room to face-to-face meetings, and we do compare different mortgages. You can add and compare side by side different kinds of mortgages, whether you want to refinance or purchase, whether you're buying this year and you can buy another home in 3 years and another in 3 years, what you're paying, what your down payment is, what your appreciation is, and what that will, above all, how much equity, how much net worth will you have? How much tax deductions will you have? What is your return on investment? There's so many things that I want people to be aware of, to think like investors, okay? To think in terms of net worth, and that's the quest I'm on. My tool is live. It's on iQRateMortgages.com. There's a tab called Wealth Planner, iQRateMortgages.com/wealth dash planner. Check it out for yourself. It's pretty
Are we
self-explanatory.
allowed to post it
Please, yes, of
in
course.
the description to this video?
Yes, please.
Thank you.
And trust me, if you spend some time on this, or not you, but the average homeowner, the understanding of homeownership changes, and the feature to turn this into a PDF and print is going to come out soon. We're working on that, so this is only an online version. But once you look at these are numbered, the five principles. Understand them, play with them, and your net worth will change.
So this is the tool, how to understand your net worth first of all, and then how to enlarge it.
Well, okay, well, let's go through this. Number one principle is homes appreciate. People know this. Not everybody understands what that really truly means and what that means in correlation of the money that you're investing. Let's say you're 5% or 10% down payment and the closing costs. So money out of your pocket you invest. versus continuing to rent. What does that mean? What happens to it in a year or two or 30? That's rule number one. Rule number two is, I'm looking at it, every time you make a payment, your principal gets reduced. So your debt shrinks and your equity grows with every payment. Your debt becomes smaller. Your equity becomes bigger. How do you calculate that? That's so abstract. And we're putting this in really, really visible, easy to understand terms. Next, your rent appreciates. So once you move out of here and buy another home, and you can add another home here, your rent's going to appreciate, which means your cash flow per month appreciates. Now, you could spend your cash flow on Netflix, or you could apply your cash flow to your principal, and you could increase your principal. That is rule number 4. Apply your increasing cash flow into your make additional principal payments. And that's when your net worth really starts exploding. And we have put that in easy to understand visuals, and that sort of projects for the next 30 years of the life of the loan. And also rule number 5, tax deductions. Most of us pay taxes, and we need all the deductions that we can get. Interest is tax deductible. So your monthly payment has 2 portions, interest and principal payment. Principal payment is what you put in your pocket, is what decreases your debt and increases your equity. And interest is what you give to the bank to have this home, but it also is tax deductible. So David's 5 principles of real estate investing, once you understand all 4, once you see how one flows into the other and how 5 work together, and you can keep adding virtually, play with it, add 3 homes, add 10 homes for all I care. And that's when you can sort of project what your net worth will be. It's a wonderful tool, and I'm really excited to use this when I do face-to-face consults with clients.
I'm really grateful that you actually put time, effort, and a lot of money into creating it, because this is the goal, guys. This is the goal. This is what David and I aim here to do. We're here to make sure that everybody can create the wealth that they want to create through owning real estate. And it might not be done overnight. It is a slow and tedious process, but if you do it right and you look back 10, 15 years from now, you will see how much you created and how much of a net worth you actually accumulated through the home ownership and through through actually getting mortgages. And don't be worried about the interest rate being high.
Play with the wealth planner. It will make you wealthy. It should. It'll tell you how.
Thank you. Am I allowed? Thank you, Gordon. So we have the #1 real estate agent from Arizona watching us. So we will be happy, Gordon, we will be happy to share the link with you so you could play with that tool, because I know that Arizona is just like Nevada. They're looking to accomplish the same goals as we do.
So we just blasted this link out to 9,500 agents in Las Vegas. I want agents to use this. I want agents to have a deeper conversation with clients, with their buyers, because you guys are the first line of contact. So Gordon's welcome to use this tool. And it really is 10 seconds of data entry, purchase price, down payment, and then a wealth of information unfolds. And a very different type of conversation happens with the buyer versus the biggest gap we have to bridge, the buyer, first-time home buyer has to bridge, is the mortgage is slightly more expensive, or a lot more expensive than their rent. And the first-time home buyer always has to make that big leap of faith into home ownership. And this helps them understand the benefits. And yes.
And David, 2 questions. So you can put in your primary residence and your investment home, correct?
Yes, because you could treat this, you can keep on adding as many different properties one after another, and you can show how much rent you're going to collect. In Clark County, statistically, we have a 4% appreciation of interest rate. I'm sorry, not a rent, excuse me, every year. So this is built to calculate 4% appreciation of rent every year for the next 30 years, which means your cash flow in the back of there's a lot of algorithms working here, are going to calculate your 4% appreciation. You click on the little button, apply to principal, all that additional principal gets added to your principal, and all of a sudden you see this boom increase in your equity. And then I also have another line, which is cash out refinance. What if you want to pull cash out to buy another home? And that tells you how much cash out and which year you will have based on your equity pay down, your property appreciation, and how much cash out you'll be able to pull to purchase more. So this really is a powerful tool in helping people to create a little real estate empire.
And it doesn't matter. So it is not Clark County only. You can apply it to any state. You just need to remember that, you just need to remember that the appreciation, can you change the appreciation from 4% to any other number?
It's a
if it adjusts. Okay, so if you know the appreciation in your state, you're more than welcome to change the number to whatever number applies to your county, to your state, whatever that number is, correct?
Yes, absolutely.
Awesome. Then we're going to post the link here in the description to the video, and we're welcome everybody to use it. Once again, David, is there a video explaining how to use the tool besides what you just told us, or is it better to give you a call and just spend 15 minutes with you to playing with this tool?
You can call me, absolutely. I just recorded a 5-minute video that we're blasting out to 95 agents. Actually 10,000 agents in Las Vegas. I'm really hoping some of them start using. This will deepen the conversation they have with their buyers, but I will also record a separate video and send it to my past clients. There is not a video on the screen. I think it would just be clunky. I wanted to keep this clean.
Thank you, Katya. And if you ever need a consultation, guys, remember, David speaks. David, how many languages do you speak?
Oh, 3. I'm working on my Spanish, but 3 for now.
Okay, so guys, if you ever need a consultation, English, Russian, Armenian, not yet Spanish, correct? Like Spanish coming soon.
Yes,
so
coming soon.
Yeah, any of those languages could be accommodated. I know that your team is even more multilingual than you yourself. So our team speaks 7 languages between our team members. So, guys, if you feel more comfortable speaking a different language, like not English, we're also here to accommodate you and to help you out. That's not that's not an issue. David, thank you so much. You're, as always, extremely helpful. We're happy that we can share the link with everybody and actually start using your tool. If we have any questions, we're going to give you a call. And have a wonderful week.
Bye, everyone. Thank you, Alexandra. Thanks
Bye.
for having me.